Welcome to Online Trading Campus. This is Jan Skoropinski with you today, continuing the new 2021 stocks course. Welcome to lesson 4, Beating the Market. This is the agenda for today. At first, we will define what beating the market actually means, followed by a stock selection introduction. I will show you a computerized set of rules, almost like an algorithm that we could follow as a long-term buy and hold investor to beat the market without any work. Stock selection is a topic we will continue talking about also at the end of this lesson, as there are various ways to beat the market, either with individual stocks or even with the equity index itself. We will establish some market timing rules, talk about other equity indices like the Nasdaq, and conclude all of this with a summary. Albert Einstein once said, "Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." So today, we're really going to look at the power of long-term investing. We're getting closer and closer to beating the market. Things that will help us massively in doing so are the decennial pattern, the presidential election seasonality, the dynamic yield curve, and the campus buy signal. And all of those set the foundation for your long-term portfolio. These things by themselves help us massively to time big picture market bottoms and tops. But what does it really mean to beat the market? Let us define that first so we know where we're headed in this lesson. Well, let us look at the past 20 years to give you a little perspective in terms of real numbers. I really like looking at the 20-year window, as this is the time frame we generally would be looking at as long-term investments, retirement funds, or wealth generation. The benchmark for us is the S&P 500. As this index has got one of the best and longest track records, we could be talking the Dow Jones as well, which would just give us a similar benchmark. Over the past 20 years, your average return on investment per year would have been just a little over 5%. 5.49% to be exact. Now, this may not seem like much, but if you initially invested $100,000 and wait for 20 years, you end up with approximately $222,000 thanks to the compound interest effect. Now, looking at an average of 5%, already we're likely to beat that by just looking at tools I've already introduced, such as the inverted yield curve, the decennial pattern, and the campus buy signal. What I'm now going to do takes a lot of outside back testing and sample size. But in general, this is the only way how you can backtest strategies, by looking at the past and seeing what worked and what didn't. After all, the argument of saying, what if you invested 20 years ago, is also kind of a backtest and doesn't really tell you what happens in the future. It just assumes similar kind of market returns in the future. Here's the interesting backtest I created. I developed a computerized backtest to sidestep recessions and to time new bull markets with just the decennial pattern, the dynamic yield curve, and the campus buy signal. And if you only follow those rules, you would end up with a whopping $355,000 after the same 20 years. When performing backtests in the market, it is important to have computerized and mechanic rules in place to tell the computer when to buy and when to sell. Otherwise, it becomes a shoulda, woulda, coulda backtest, right? Doing it the computerized way, there are no what ifs and buts, just simple rules that tell the computer to buy now and sell tomorrow. Here I simply used 3 of the indicators you already learned to time tops and bottoms in the market: the decennial pattern, the dynamic yield curve, and the campus buy signal. The decennial pattern simply gives us an idea on timing new bull cycles. So the focus on the decennial pattern is the buy years ending with 2 or 3. Here I tell the computer to only start buying in the years ending with 2 or 3, as these are historically the start of new bull markets. Also keep in mind that the computer can either only buy in the beginning of the year or the end of the year. This is to simplify the rules. The yield curve we can use to time tops, understanding when to find the doors and run. The rule is that when the yield curve inverts, we sell and take targets at the end of this year. And the Campos buy signal helps us to time the bottom after a crash. The rule I told the computer here is to buy in the beginning of the next year if the Campos indicator flashes green and the yield curve is positive. This is because if the Campos buy signal flashes green in mid-2002, I would have not known this in the beginning of 2002. So I have to buy in the beginning of the next year or the end of the same year, which anyways would be very similar. Okay, as you can see, the rules are computerized. We could refine them with monthly demand here and there and buying on the month with seasonality, but hey, let's keep it real simple. And I'm sure you will still love the results regardless. In the year of 2000, we wouldn't be invested, right? Inverted yield curve and years ending with 0 are not great years in the market. We would expect a recession. When do we invest then? Well, as per the rules, only in years ending 2 or 3. So 2002 or 2003. Here the yield curve is healthy, and more importantly, the Campos buy indicator is flashing green in the middle of 2002. So the computer would buy in the beginning of 2003. We're now fully invested in the market with $100,000. At the end of this year, we're already nicely in the profits with a nice percentage gain. Now, do we take the profits? No, we're invested in the long run. We need to stay invested here to make use of this natural upward drift in stocks. As per the rules here, we stay invested until the yield curve inverts, which only happens in mid-2006. Inverted yield curve plus years ending with 7, usually not great years in the market. So we find the doors and run. The computer sells at the end of this year, as it cannot sell mid-year. Now, after this first bull cycle, we go from 2003 to 2007. Our $100,000 initial investment goes to roughly $156,000. So now we have a lot of cash laying around and we're not invested. We need to look for new entries. 2008 comes along and 2009, which was the bottom of this crash. And arguably, as human traders, we would probably look to buy here already. The Campos indicator flashes green and continues to be flashing green for a long time. But again, I have to tell the computer to use a clear set of rules. And in this case, we only buy in the years ending with 2 and 3. So either 2012 or 2013. In this case, the computer buys in the beginning of 2012, even though we could have probably bought earlier as traders. How long do we hold it this time around? Well, again, until the yield curve inverts. This again is when we find the doors and run. By the end of 2019, the yield curve inverts. The computer sells all positions at the end of this year. As a result, we walk out with approximately $357,000 of capital. Wow, clearly we can beat the market using a simple computerized set of rules. This set of rules we can even refine a little bit later on. And let me tell you, I've done a lot of backtesting on that, walking back 100 years. And this by itself consistently and comfortably beat the market over time by big numbers. Now, compare this to buy and hold to the right. Yes, after 20 years, we're also in the profit here, but look at the difference. And let us visualize this for a moment here as well. In blue, you can see the Campos computerized buy and hold strategy, and in red or orange, you see the classic buy and hold. Look at the emotional backdrop you may have gone through when investing in 2000. You basically wait for 12 whooping years to go back to break even with a maximum drawdown of minus 40% in 2002 and 2008 again. This can come with all sorts of emotional distress, which can result in decision-making problems. So the key takeaway here is that we can beat the market with a simple computerized approach by big numbers. With our strategy, you would have made a 255% return in 20 years, and with the classic buy and hold, only a 122% return. And secondly, emotionally, this is also a lot less stressful as we're able to sidestep recessions and protect our capital at all times, which you can see from 2000 to 2001 and 2007 to 2010. So you may be asking, well, what else is there going to be then? Simple stock selection. Yes, we can make our lives very easy and invest in the equity indices themselves, like the S&P 500 or the Dow Jones Industrial Average. And there are also a lot of advantages to that over and above the stock selection part. But what if we could select some of the winners to further outperform the market? That would come with a little more work, but it could be key to further outperform the market. Finding the right stock is like finding a needle in the haystack. There are various ways to select stocks today, and very generally, we can say that the more popular a stock selection strategy or a stock itself is, the less likely it is to work. And that has been a pretty good operating rule in the past. You may get a stock recommendation from a friend of yours at work or your family, or maybe you just read an article about it. Now, don't get me wrong, lots of these become big winners, and we may want to roll the dice on those every now and again. There's nothing wrong with that, but those new stocks should not make up a serious amount of your total wealth. One of the great myths of Wall Street is that you must catch these high flyers to really succeed in Wall Street. And that's not true. Our main goal is to operate on a consistent, longer term strategy that produces results year after year, and to make use of the compounding effect consistently. And these do not have to be high flyer results to really make headway with your retirement funds. The focus should be on consistency. So the question we should ask is the following. Looking at the past decades of stock performance, what are the most consistent reasons of stocks going up in value? And answering that is actually very simple. Again, the Fed here is providing us with the basic principles they look at. And I've already alluded to that in the previous lesson. Remember, the Fed mostly looks at two fundamental principles: the spread between treasuries or interest rates, or in other words, the yield curve, and PE ratios. So PE ratios are going to play an important role in selecting stocks. One of the most important basic principles to understand long-term investing is that stocks that create long-lasting trends are the ones that produce consistent earnings, which ideally increase over time. In other words, stocks that have a value. And ultimately, history shows that value is rewarded in the long run. So how do we identify value, and how do we determine earnings? Let us look at that now. Value can be argued in two ways. The first is innovation. People love innovation. They love new things, and investors are always on the lookout for the next new innovative marketplace. And in fact, popularity on what the new thing is has rotated over the years. One year it was drug stocks, then biogenetics, followed by computer chip manufacturers, cryptos, even though cryptos are not stocks, then wheat stocks, and now once again, big tech companies. There's always a certain group of stocks that benefit from this natural rotation of money, finding its way to the darlings of the day. Now, the problem is that looking back, it is extremely difficult to know beforehand which group of stocks is going to benefit the most in the future. So this approach is really not consistent because we only know once we know, and then it's mostly already too late. The second way on arguing value is finding the companies that are making money. And this one is by far the more consistent and stable approach. If a company makes money and increases their earnings, the price of the stock goes higher. This is not revolutionary, but investors often forget the simplicity of investing. And oftentimes, the simpler and more consistent the approach, the better and more consistent the long-term results. This is because big money and smart money prefers consistency. Big money hates the unknown and wants to eliminate the fear of the future. So it makes a lot of sense that the Fed looks at earnings, or in other words, PE ratios, as one of their key decision drivers. As a long-term investor, you want to combine both of these worlds. Ultimately, you want to invest with the smart money. And while we're going to focus on value in terms of companies that make money, so earnings ratios and PEs, we're also going to look at these innovative stocks that as a group seem to outperform the rest of the market. This is called comparative strength. Easy enough, comparative strength and stocks that make money. However, there are still hundreds, if not thousands of potential stocks that would apply to this scenario. Now, what I'm going to show you is going to make your lives very, very easy, and I've alluded to that already in the first lesson. At first, we're just going to narrow down our list of potential stocks to the Dow Jones Industrial Average, and from that list, we're going to identify the 5 or 10 stocks with the most upside potential, avoiding the losers, which is going to be easy, and focusing on the winners, which is a little harder. But even if we just take out the losers, we are very likely to outperform the Dow Jones and therefore outperform the general market. Basically, we're going to create our own basket of stocks, our own index, if you will. Call it the Campus Equity Index, but not so fast. Let us first look at the Dow Jones. What is it about the Dow Jones Industrial Average that is so interesting to me? Well, first of all, there are only 30 stocks in this index, which narrows down our list of potential stocks massively. And all of those 30 stocks are so-called blue chip companies. They are supposed to represent the full market. And this is still true today. Overlay the S&P 500 with the Dow Jones and you will see that those charts are basically the mirror image. Even though you have 500 companies within the S&P 500 and only 30 within the Dow Jones. So the choice between the two is simple. We don't have to look at 500 companies. We can simply look at the 30 included in the Dow Jones. In 1884, Charles Dow created the foundation of the Dow Jones we have today. Back then, the stock average was composed of 11 stocks only, which most of them were railroad companies. By 1896, so 12 years later, the list grew to 12 stocks. And all of a sudden, none of them were railroads anymore. Some of the stocks back then that may sound familiar to you were General Electric and American Tobacco. In 1928, the list had expanded to 30 components, just like today, but the companies back then were very different. Throughout time though, over 20 companies in the Dow have been in business over 100 years. This tells us something. This tells us that the companies listed in here are extremely safe. They usually do not go bankrupt. These companies are here to stay and to perform and to grow. And these companies are changing over time to the ones that are most relevant to the current economic climate. The people at the Dow Jones organization do this work for us. They constantly remove dead wood and introduce new stocks. Now here's the interesting idea. I'm especially interested in the new wood they are adding to the average because those companies represent new innovative industries and technologies, and there are going to be certain ways we can filter them out from the group. Why? Well, think about it. Wouldn't you like to get Microsoft early in the game or Apple early in the game? Yeah, sure. For example, Apple was only added to the Dow Jones in the year of 2015. To put this into perspective for you, in 2015, Apple was only trading at $20 per share, while today it is trading at $120 per share. Well, considering the stock split, so the price has changed, however, the percentage gain is the same. Microsoft was added in 1999. Back then, it was trading at $35 per share. It is now at a whopping $200 per share. And the list goes on and on and on. So my point is, their track record of adding new stocks that are innovative, valuable, and make money in the long term is impeccable. Understanding this concept gives us the opportunity to look at the right innovative companies early on, early enough to still have huge growth potential, but established enough companies to not risk a total blowout of your capital. And lastly, the Dow Jones Industrial Average is not really an average. It is weighted, which works in the favor of the investor. This is why these averages are really designed to go up over time. What happens is that the 30 stocks composed in the Dow are given a certain weight. And that weight is based on their price. So in other words, a free-floating weighted average, with the highest priced stocks or the best performers given the biggest weight. Most other indices are based on market cap. The Dow Jones is based on price, and that really works in the investor's advantage. There are really two ways on how we can approach this now. Either we buy the Dow Jones Industrial Average or the S&P 500, or we pick out 5 stocks to create our own Campus Equity Index. Both have their unique advantages and disadvantages. Buying the Dow Jones is a lot easier. The Dow Jones has a solid long-term track record. It is less time consuming as we do not have to identify and sort through 30 stocks. And most importantly, we do get a lot of leverage here. This is the aspect I like the most about just buying the Dow Jones, because with the additional leverage we get from trading futures or CFDs, therefore my preference is to just buy the Dow Jones. However, I will show you both ways. With picking out stocks, even though it is more work and it requires more of your own capital, you potentially can further outperform the Dow Jones in terms of percentage gain. The big advantage on the stock side is the following. If you have a lot of capital and you want to put your money to work almost all of the time, you can achieve greater percentage gains than using the index itself. Let us first talk about market timing and the Dow Jones option. And the beauty about this market timing strategy is that it comes around year after year. So we can use the same strategy every year. To get a general idea on market timing, I like to first look at the Dow Jones seasonality, the seasonal lows and seasonal highs, as well as the strongest month within the calendar. Here you can see the following. What is amazing to see is that the Dow Jones is extremely seasonal. The last week of October all the way until the end of the year and potentially all the way until end of April are extremely bullish. The worst months are May until September. And therefore, we want to avoid these months right here. This is the time to take profits and wait for re-entries within monthly and weekly income. Here you can see the Dow Jones during the last bull market. Quite amazing. You can see the largest drops happen from May to September, and the biggest gains are made from end of October, November, all the way through April. So there is some truth to this saying, sell in May and go away and come back in October. However, we will use this a little differently. We will sell in May and come back in October, yes. However, we're looking to buy into weakness during May to October timeframe. And if we cannot seem to get a handle on this, we would be looking to trade reversals or smaller timeframe pullbacks on daily charts. Think about it. Comeback in October is not a revolutionary idea in the stock markets. Almost anyone who's trading stocks has heard of that before. So almost every time we can see a bigger size drop in the beginning of October. Now, understand that the seasonality begins in the last week of October. We can potentially already position ourselves into October weakness. You guys still remember the example from the previous lesson, from last year, 2020, where we picked the November lows also during the presidential election period and rode some big waves on the indices all the way until the end of the year. But also look at this example from the year 2019. Just in October, the markets drop right into demand. So if you enter just on the 1st of October, you get your clocks cleaned. And then towards the end of October, Dow Jones just starts to take off. When we are here, not yet positioned, we should be aggressively looking for daily demand and pullbacks. In this example, would we have bought until May? No way. 2019 inverted yield curve in August 2019, 2020 approaching. We can buy here, but we must manage our positions aggressively and even look for shorting opportunities. Another example, just the year before that, 2018. Look at this. If you come back in the beginning of October, you got your clocks cleaned big time. Can we buy into weakness using weekly and daily income? Absolutely. And we could have tried here with the first daily demand covered by weekly, just like in the previous example right here. Would have gotten a little bit of a bounce, but the markets were really falling apart back then. Also remember, the more aggressive option to buy daily pullbacks into daily demand is only allowed from the last week of October onwards. And from the last week of October, we do get the smaller push back up, but the sellers are clearly in control. Interesting learning here though is that October 2018 is right before pre-election year seasonality. What did we learn about this seasonality? What month is the better entry? Let me refresh your memory here. January 2019. Right, so here you go. In this case, the presidential election seasonality superseded the normal end of October seasonality. And this is also usually what happens during election years. Therefore, as a rule, we always want to be trading election year seasonality during pre-election, election, and post-election year. And also October seasonality is just like any seasonality. It does not work every year. But combining all our tools like the decennial pattern and the dynamic yield curve, as well as election seasonality, we can pretty accurately look at the months we want to focus on. And whether we are planning to buy the Dow Jones for longer, all the way until May, or potentially only for a shorter period of time, which means we should protect ourselves and our trades more aggressively in terms of trailing. On top, what was the yield curve like? Flattening, more uncertainty around the future. Also, probably a good time to be more aggressive here in terms of trailing and profit taking. Last example on seasonality before we wrap up market timing with a summary and rule cards. Let us go back one more year again. The year of 2017. Now, pretty damn good year, and honestly speaking, we would have had a pretty hard job trying to time an entry within October. either buying into weakness beginning of October or buy daily pullbacks in last week of October. But again, who has the answer to this? Exactly. 2017 was post-year election. And we should have been positioned since February 2017 already. Now, question to you. If you are riding this wave, are you just going to jump off of the surfing board? Or are you going to try and trail and ride the wave until the end? Right, we would be trailing here. And by the time we reach October, we are long positioned. What does the yield curve look like back then? Very nice and very healthy. Hence, we can position ourselves for the longer term. So here are your rule cards for long-term investing. Most importantly, do not just come back in October and buy blindly. If we see weakness in the months of October, we want to buy low, very low, using weekly income. Alternative option is we wait for the last week of October. From this week onwards, we are allowed to buy lower timeframe pullbacks into low and very low areas using daily income. Election year seasonality has a higher priority than the Dow Jones cycles. Prior to buying, we need to be aware of the dynamic yield curve. Ideally, we want to see a healthy yield curve. If the yield curve is flattening or inverted, we can still buy using the same set of rules, but we do not want to hold all the way until May. We look for profitable exits or protect our open and running trades with trailing stop losses, just placing them below daily demand. Also, we want to understand the year in terms of the decennial pattern, especially when it comes to year 5, we want to be super bulls. Here we generally do not want to close our positions approaching May. We want to hold on to our positions until things change fundamentally. This is the only way we can benefit from this natural updrift in price. And here's the most important rule of this slide. Year 2 and 3, especially in these years, if we get into a trade here looking at monthly income or weekly income, we really want to hold on to that trade for the years to come, don't we? If we can enter a trade in Dow Jones using monthly income in 2022 or 2023, or even now in the year of 2021, approaching 2022, we want to hold on for this for a longer time and only trail using weekly income. Here we want to make use of this natural phenomenon of stock prices drifting higher over time, with the only caveat to check the yield curve, and this should be healthy. This is our only window in the decade to really create a buy and hold for yearly long-term positions in the Dow Jones. And this is exactly why we timed this course to be launched in 2021, because we know 2022 is approaching and we all need to set our minds up for a longer term bull cycle just right around the corner, and we need to be buying for the longer term whether we like it or not. And here you go. This was prime time to buy and hold. End of October seasonality, post-recession, approaching year 2, healthy yield curve, and prices in monthly high quality demand. And not only this, also the Campos buy signal was flashing green right here. This will be definitely something to look out for in 2021 and 2022 and 2023 within the October seasonality. This right here was the easier approach to tackle the longer term market. Very simple strategy. We get a lot of leverage, we can easily hold bigger positions, and it's reoccurring every year and every decade, with slight changes on trade management depending on the fundamental tools I've already taught you in this class. Let us now focus some time on the alternative for the ones that sit on a lot of capital and wealth. The ones that really want to put their money to work almost all of the time and be almost fully invested. For this, we want to focus on stock selection, and I will now spend some time to really guide you through the process. Now, this wouldn't be a longer term stocks investing class if I wasn't introducing fundamental valuation metrics that have historically been proven to work extremely well. and I want to put those fundamental valuation metrics into perspective for you. Here you can see the PE ratios of the Dow Jones Industrial Average as of October 2020 compared to the previous year. In October 2020, the PE ratio was 28.05. But what does that really mean? How do we use that number? As of now, we just know that the PE ratio is potentially important because that's what the Fed writes about in their market timing papers. We can use this information to get a general understanding or a sense of valuation of the stock market and what the expected return or growth of stocks would look like for the next years. And for this, we would use a PE ratio formula and compare those results with the average rate of return to get an understanding whether today's PE ratio is high or low in terms of overall valuations. And this formula is really simple. The best one I found is the following. You just take today's PE ratio and multiply it by 0.57 and subtract 20.67 from the result. This would give you the expected 5-year average return. We could then compare this result to 10.46, which is the yearly rate of return over the past century, which then gives you a valuation measure. If the result is above the 10.46%, the market is generally undervalued as the expected returns are greater than the average. If the result is below the 10.46%, the market is generally overvalued as the expected returns are smaller than the average. So for October 2020, the PE ratio formula gives us a percentage of 4.68%. This means that the overall market is overvalued as the expected yearly rate of return is way below the average of 10.46%. Actually, it is less than half. Compared to last year in October 2019, the PE formula gave us a percentage of 9.7%. Now this is close to the average of 10.46%, but still below, and therefore the market was still slightly overvalued, though not by too much. Let us go a step further and look at the major peaks and bottoms in the last 20 years to compare the current PE ratio to get a better sense of what this really means. This is the SPY. I'm using the SPY here as an example because it's difficult to find historic PE ratios of the Dow Jones. Most websites offer SPY ones for free, and this formula can also be used on the S&P 500. In January 1999, prior to the dot-com bear market, the PE formula gave us an overall valuation of 1.9%. That's pretty bad, considering the yearly return should be 10.46%. At that point, investors should only expect a 5-year average return of 1.9%. Here, the overall market was significantly overvalued. In January 2008, prior to the housing collapse bear market, the PE formula gave us an overall valuation of 8.43%, only roughly 2% below the long-term average. Not too bad, but also not great. On paper, the market was overvalued. And in January 2012, post-recession, the PE formula gave us an overall valuation of 12.2, so 2% above the long-term average of 10.46%. In this case, the market was undervalued. Now in October 2020, the markets overall are fundamentally overvalued, significantly overvalued. Not as bad as during the dot-com bubble, but we were pretty close. But here's the deal. So what? What does this really tell us? It doesn't allow us to time the market. It doesn't tell us when to buy or when to sell. It doesn't tell us if we're going to go higher or lower. All it does is it gives us a general understanding or a sense of valuation of the stock market and what the expected return or growth of stocks would look like for the next years. The one big takeaway here is that the lower the PE, the better, or the longer term our future growth outlook, and the higher the PE, the worse or the shorter term we would be buying stocks for. This right here is the important statement, an additional fundamental rule we should be adding to our market timing rules. If the PE valuation matrix is overvalued, we would be buying for the shorter term. If the PE valuation matrix is undervalued, like it was after the housing crash, we want to be buying long term. Mortgage everything you have and go all in stocks. Of course, I'm kidding, but this happens very, very rarely. Now, we talked a lot about trading the Dow Jones already, or as a matter of fact, any other equity index. And before we now talk about stock selection within the Dow Jones, I want to talk to you about another index, the Nasdaq, and why the Nasdaq has been gaining a lot of relevance lately. Some of this related to the corona crisis and the political measures undertaken to fight this crisis, like economic shutdowns and lockdowns. But as I will show you now, there is a real longer-term fundamental driver that make the Nasdaq a truly relevant index for the future. First, let us look at retail sales. We can see that the longer-term trend for retail sales in the US is constant. Yes, there are some swings during economic anomalies like recessions or crises, but overall, the average is pretty constant. There is no growth in retail. During the corona crisis, all retail stores were on lockdown, no sales. The ratio just plummeted. And it is fascinating to see consumer behavior when shutdowns were lifted. It is almost as if consumers made up for the lost time. They couldn't go shopping. Now you may ask, well, Jan, why is this stuff important to us? And for the Nasdaq? Well, this gives us a base for the next slide. Look at the consumer behavior here and what they are doing online vis-a-vis retail. Almost 15% of all sales are now being done online. It actually got up to almost 17% earlier this year as the lockdowns hit the economy, and it has come back a little bit now. But the point is, this is not an anomaly. This is a clear trend. And that has started way before the coronavirus, just exacerbated by it. This is the way of the future, and therefore, as long-term investors, we need to keep this in mind, as there is a fundamental change in the way people buy and where they shop, how they shop and what they buy. Think Amazon, Google, eBay, PayPal, Visa, and the list goes on and on and on. And for those of you that have been with us during the November-December 2020 timeframe, know we had a big focus not just on the Dow Jones, but also on the Nasdaq. We call it the index on steroids. And this graph right here visualizes amazingly why the Nasdaq has been outperforming all other indices. Long story short, the Dow Jones end of October investing strategy can be applied to all of our equity indices, the Nasdaq, the S&P 500, the DAX, or even the Japanese Nikkei. Isn't that great? All of these markets go up and have a very bullish seasonality during the same time frame and the same time window. All we have to do is pick one and choose. Now let us talk about stock selection. I want to introduce to you a new longer-term stock trading strategy I spent a lot of time backtesting. Before I go into the strategy, let us first talk about our main pillars of any strategy. It needs to be simple, mechanic, rule-based, and periodical. So we can do the same things every year. Today, there's an abundance of fundamental indicators and valuation metrics that traders look at, like price to sales, price to book, and debt to equity ratios, as in we want to avoid companies with high debt, and the list just goes on and on and on, and investors just get buried by an abundance of information. I found the more information you have, the less likely you are to be decisive. Therefore, when I looked at this, my main priority was to keep life simple, be mechanic and rule-based, and find a periodic trade we can look at. What do we know? We know that our dear friends at the Federal Reserve look and write about in their market timing papers are PE ratios. We've just learned and we know that we want the PE ratio to be as low as possible. The process we will be following here is quite simple. We want to pick individual stocks that are relatively low compared to the ones that are listed in the Dow Jones. Another factor we want to focus on are low price stocks within the Dow Jones. There is a law called the law of square roots, and this really goes back to old-timer investing books. Great long-term investors like Warren Buffett or Lynch knew about this concept. Stocks are known to move in square roots. Check this out. It's simple math. A $100 stock, which is the square root of 10, will move to the next square root of 11, which is in turn a $121 price per share. A $9 stock, which is the square root of 3, will move to the next square root of 4, which in turn is a $16 per share stock. A $4 stock, which is the square root of 2, will move to the next square root of 3, which is in turn a $9 stock per share. As a result, a $3 stock makes a 125% move as easily as a $9 stock makes a 77% move, as easily as the $100 stock makes a 21% move. This effect on investing is huge. One of the simplest, best investment rules I've ever come across. And when you backtest this, you will find that low price stocks tend to have larger percentage up moves than higher price stocks. So big is good, but small is better. The concept here is to buy low price stocks that have value to them. We want to buy the ones that offer the best value relative to the overall Dow Jones valuation. So there's a fundamental difference between high-priced and low-priced stocks, between high PE and low PE ones. But how do we go about finding them? Very simple, let me show you. This is where the rubber meets the road. Go to the following website, www.finviz.com. Here we can easily screen and select the criteria we're looking for from various pull-down menus and bars. At first, we want to select the DJA, which is the stock ticker symbol for the Dow Jones Industrial Average. Remember the first lesson. If a stock is in the Dow Jones, it's a blue chip stock. And we can be sure that these stocks have some value to them. Plus, it simplifies our approach because it narrows down the list to 30 companies. Now click on Valuations, the tab below, which will give us an abundance of valuation metrics. But don't worry, all we'll be looking at here is the PE. In fact, the Fed writes about forward PE and price, a low price. In the next step, we can sort by price, which will give us the lowest price stocks first. And from that list, we want to filter out the ones that also have a low forward PE ratio. There's not really a magic number here when it comes to PEs. All we want to look for is for the PEs to be low relatively to the other stocks. The PE should not be 0 or negative though. As a result, we should get the ones that have the most upside potential from a fundamental standpoint. I found that most times low price stocks have low PEs. So these valuations are kind of correlated, which also makes sense. If the PE was higher, the price of the stock was higher as well. As of now, we have not even done any charting yet. We are just looking at stocks that offer a high percentage return so we can put our money to work unleveraged or with very little leverage. This is the list we get: Walgreens, Cisco, Intel, Coca-Cola, and a company called Dow. Now we can create our own index. Call it the Campus Equity Index if you will. We want to choose 5 stocks, approximately 5 stocks. We can take more or less, but to have a systematic and mechanic approach, it is good to have an amount of stocks and then just stick to this amount every year. Also, there will not be a weighting difference on the stocks we buy. If we buy 5 stocks, we put 20% of our capital into each stock. So if you have $100,000, you want to put $20,000 into each stock. What's next? We go to TradeStation, our beloved charts, we put in the ticker symbols. I've already done that in the benefit of time, and we look to buy at the end of October, beginning of November. The thing here is I want to compare apples to apples and not apples to onions. So what I will do now is to look at the Dow Jones first. The entry we had in the beginning of November, the 2nd of November to be exact, which we also talked about in our live trading sessions, and compare the same date as an entry point on the stocks we wanted to buy based on the fundamentals, and then calculate the percentage gain. Dow Jones versus our Campus Equity Index and versus Nasdaq. So here you see Walgreens, Cisco, Coca-Cola, Intel, and a stock called the Dow. The exit date is going to vary on the underlying fundamentals, yield curve, and the decennial year we are in. We get into a November trade in 2002 or 2003, we know what to do. Let the good times roll. What you can see here is remarkable. Look at this. The Campus Equity Index outperformed not only the Dow but also the Nasdaq by more than 8% over the last 2 months without any market timing. Sure, we go into market timing, supply and demand, and price action. We may get even slightly better or worse entries. But just looking at the same entry and exit dates and what a low price and low but positive forward PE can do is amazing. Also, very interesting to see is that Coca-Cola is the worst performer in our Campus Index. And look at the PE ratio. It has the highest PE ratio of the bunch. Look at the best performer, Walgreens, and look at its PE ratio, the lowest of the bunch. Quite amazing, isn't it? This is the power of low price and low PE within Dow Jones stocks. This is how we choose value. And I have done a lot of outside sample backtesting on this. And with this simple approach, we can outperform the market. Now go ahead and do the backtest yourself. Now also I have to admit here, this is not revolutionary and this is not my invention. I'm just looking at the Fed market timing paper, backtesting the things that they're saying and projecting that and tweaking that into the real world of trading. And you may also say 8% is not too much. Well, year over year over year over year, this can make a huge difference on your wealth accounts. Also, no need for mutual funds. They underperform even the equity indices and they come with high fees. So how about no fees and overperforming with little effort? Better than a mutual fund in my books. When to buy and how long to hold? Again, we look at the rules earlier with an additional rule right here, because we're not just buying an index, but a list of individual stocks. We have to work on those positions every half a year to a year, whenever the list changes. Dow, for example, is a stock that was only introduced into the Dow Jones in 2020. And look at this, we get a handle on this right from the beginning. Remember when we spoke about Apple only being introduced into the average in 2015 and Microsoft in 1999, and how we can get a handle on these very innovative new companies early on? This is exactly how, because we are trading the cheapest and therefore the newest companies within the Dow Jones. Amazing, isn't it? Whenever another product gets into that list, we will be rolling over. We could be smart about it, sell the expensive outdated ones in May, and look to position the new ones only in November again. This is where the work comes into play. This brings us again to this slide, the summary of this lesson. Can we outperform the market? Well, the data proves it. Yes, we can. But how much effort did you put into picking out individual stocks as compared to just buying the index? Plus, we get a lot more leverage on the index itself. Now, if you have a lot of cash laying around and you want to put it to work, regardless of what you do in terms of trading indices or trading stocks just based on supply and demand, like buying Apple in demand or Amazon if and when it comes to demand, then this is the way to do it, especially if it's going to be the year 2022 and 2023. Sure, some years it may not work out and we get stopped out on our positions. After all, there's nothing that works 100% of time. But overall, looking at the seasonality and the decennials, most years are positive during this time frame, especially if the yield curve is healthy and we are in a favorable decennial year. One reason to buy the stocks without leverage is that these positions are easier to hold longer term, and therefore it is more likely to catch that upward drift. Therefore, and this is most important, we are talking about long-term investing here. In the long run, this is how we can position ourselves for the longer term in stocks, creating wealth and retirement, allowing us to benefit from this natural updrift in the market. This is the end of this lesson. Up next, technical analysis, supply and demand, and comparative strength. Until then, thanks everyone, happy and safe trading, and ciao.